Most traders believe they fail because their strategy is flawed, the market is unfair, or they simply haven't found the right indicator yet. But the truth is far simpler and far more uncomfortable. What stops the vast majority of traders isn't the market, it's themselves. The market offers unlimited freedom. It doesn't require your permission, it doesn't punish or reward you, and it certainly doesn't care who you are. Yet this very freedom exposes the one thing most traders never learn to master: their own beliefs about risk, uncertainty, and self-worth. Trading psychology isn't about feeling confident or repeating positive affirmations. It's about rewiring the internal mechanics of how you perceive opportunity and danger. And this is where most traders fall short. They read, they understand, they nod in agreement, but they don't transform. Why? Because transformation requires acceptance. Acceptance that anything can happen. Acceptance that you will never know the outcome of the next trade. Acceptance that your job is not to predict, but to execute with perfect neutrality, regardless of results. Most traders say they accept uncertainty, but their behavior reveals the truth. They hesitate, they override rules, they chase, they avoid loss, they personalize outcomes, they cling to the illusion of control. They trade to satisfy emotional needs rather than to express a probabilistic edge. And so the concepts that should liberate them end up failing them. Not because the concepts don't work, but because the trader refuses to let go of the need to be right. Today, we're going to confront that reality. Not to discourage you, but to free you. Because once you stop trying to control the market and start mastering your own responses to it, you step into a level of consistency that 90% of traders will never experience. Your breakthrough doesn't come from learning more. It comes from letting go. Most traders understand the concepts intellectually but never internalize them emotionally. At first glance, that statement sounds simple, almost obvious, but its implications run deep into the core of why the majority of market participants struggle, suffer, and ultimately fail. The distance between intellectual understanding and emotional internalization is exactly where the gap in trading success is created. You can read every trading book available, memorize every rule, repeat affirmations, design strategies, backtest setups, and even understand the logic behind risk management. Yet none of that guarantees you will behave in alignment with what you know when real money is on the line. Knowledge is not the problem. Emotional acceptance is. To understand why this happens, you have to consider what trading actually demands from you as a human being. Trading requires you to operate in an environment of complete uncertainty, where outcomes are unknowable in the short term, and where anything can happen at any moment. The irony is that human beings are wired to seek patterns, control, safety, and predictability. We want stability, reassurance, and the ability to link causes to effects in a tidy narrative. But the market does not offer any of that. It does not reward effort, logic, intelligence, or emotional investment. It only reflects probability. So the moment a trader confronts uncertainty, the logical left-brain understanding of follow your edge and manage risk comes into direct conflict with the emotional brain's desperate desire to avoid pain and seek certainty. That conflict is where emotional internalization becomes essential. Intellectual understanding tells you that no single trade matters. Emotional internalization allows you to execute as if that were truly deeply believed. Without that internalization, a trader may acknowledge that each trade is just one in a series of probabilities, but the moment money is at risk, fear rises, the need to be right resurfaces, the urge to protect the ego becomes dominant, and all the rational principles collapse under pressure. A trader might know they should cut a losing trade quickly, but knowing is not the issue. They hesitate not because they lack information, but because they have not emotionally accepted the randomness of outcomes and the inevitability of loss. Their emotions are still wired to believe that avoiding a loss means avoiding personal failure. They equate being wrong on a trade with being wrong as a person. So the trade stays open. The loss grows, logic becomes irrelevant. Most traders also intellectually accept that markets move in probabilities, but emotionally, they still behave as though each trade should work if they've analyzed it correctly. They expect certainty, even though they consciously know certainty does not exist. Emotional acceptance means you no longer expect the market to respond to your analysis, no longer require proof that you are right, and no longer view losses as threats. Until those emotional shifts occur, the trader remains trapped in old patterns. The analytical mind understands the principles of probabilistic thinking, but the emotional mind continues to fight uncertainty, trying to force outcomes where none can be forced. The deeper truth is that emotional internalization requires the dismantling of beliefs formed long before trading ever entered one's life. These beliefs are shaped in childhood, school, family, culture, and the broader world. We are taught from an early age that mistakes are bad, that being wrong is something to avoid, that success is linear and predictable, and that hard work guarantees results. All these beliefs operate in the background of a trader's mind, influencing behavior without their awareness. But the market operates in the exact opposite manner of these ingrained beliefs. You can do everything right and still lose. You can do everything wrong and occasionally win. Effort does not guarantee outcomes. Passion does not matter. Desire does not matter. The market is neutral, indifferent, unpredictable, and often ruthless to those who cling to the illusion of control. So when traders read about discipline, patience, acceptance of uncertainty, and probabilistic thinking, they understand it conceptually, but it conflicts with decades, sometimes lifetimes, of conditioning. Emotional internalization requires the unlearning of those old patterns. It demands the rewiring of core beliefs about control, risk, and identity. That process does not happen simply by understanding trading psychology on an intellectual level. The brain operates on emotional memory, not logical memory. Intellectual knowledge sits on the surface, but emotional belief sits deeper, rooted in experience and reinforced through repeated emotional responses. This is why a trader can read a principle and nod in agreement, only to sabotage themselves minutes later. The emotional brain always wins in moments of stress. It is faster, more powerful, and more deeply ingrained than the logical mind. Without emotional internalization of trading principles, the logical mind is simply not strong enough to override instinctive impulses. You can tell yourself that you will exit a trade when your stop is hit, but if your emotional mind still perceives a stop out as personal failure, the instinct to avoid that emotional pain will override the plan. This is why traders repeatedly make the same mistakes, even when they fully understand the consequences. They know what should be done, but emotionally they cannot follow through. Emotional internalization occurs when the trader no longer merely knows something, but accepts it at a level where it no longer produces internal conflict. When a trader truly accepts that anything can happen, that any trade can lose, that losses are not a reflection of their identity, and that uncertainty is not a threat but simply a characteristic of the market, they begin to behave differently. They stop hesitating. They stop forcing trades. They stop seeking certainty. Their actions align with their knowledge. Their discipline no longer requires effort because there is no longer emotional resistance to doing what needs to be done. But for most traders, reaching that emotional state requires confronting discomfort. It requires experiencing loss without assigning personal meaning. It requires allowing uncertainty without trying to control it. It requires taking trades without emotional attachment to the outcome. That level of detachment is not natural. It must be developed. And developing it demands intentional repetition, self-awareness, and a willingness to feel the emotional discomfort rather than avoid it. Many traders never reach that point because they continue to seek intellectual solutions to emotional problems. They read more books, watch more videos, tweak systems, and look for external solutions when the real challenge is internal. The gap between intellectual understanding and emotional internalization is also why traders often believe they need more technical knowledge, more indicators, or more strategies. In reality, they already know enough to be successful. What they lack is the ability to act consistently in the face of uncertainty. They think the missing piece is a new strategy, when in truth the missing piece is emotional acceptance. Until they accept uncertainty at a deep level, no strategy will save them. No indicator can protect them from themselves. No analysis can overcome emotional fear or stubbornness. When a trader internalizes these principles emotionally, something profound happens. Trading becomes effortless, not because the markets become easier, but because the internal conflict disappears. The need to be right dissolves. Losses stop creating emotional turbulence. Wins stop inflating the ego. Each trade becomes simply an expression of an edge, not a test of identity. At that point, the trader is free from fear, free from hesitation, free from the emotional baggage that once dictated their behavior. But reaching that freedom requires facing the reality that intellectual knowledge is not enough and never will be. emotional internalization is the real work. It requires humility, self-awareness, and the willingness to let go of beliefs that once felt essential to one's sense of self. Most traders never make that journey. They stay trapped in the cycle of knowing but not doing, believing but not behaving, understanding but not accepting. The market does not punish them for this. It simply reflects the consequences. The real failure is not in the market, not in the strategy, not in the knowledge, but in the trader's inability to bridge the gap between understanding and acceptance. When that gap is closed, consistency emerges. When it remains open, inconsistency rules. And for most traders, that is where their journey ends. But for those willing to internalize emotionally what they already know intellectually, the journey begins anew, with clarity, with confidence, and with the realization that mastery was never about learning more, but about letting the truth finally sink in. The ego, the need to be right, and the attachment to outcomes override disciplined thinking in ways that most traders underestimate. This isn't a flaw unique to trading, it is deeply human, but the market exposes these traits more brutally and more immediately than almost any other environment. Trading demands behaviors that directly conflict with the natural impulses of the ego. While many traders claim they are logical, disciplined, and objective, their actions show a very different story when money, uncertainty, and emotional risk enter the equation. The gap between how traders think they behave and how they actually behave becomes the silent force that destroys consistency and sabotages success. To understand why this happens, you must understand what the ego truly desires. At its core, the ego seeks one thing: validation. It wants to be right. It wants to feel competent, special, intelligent, superior. It wants to believe it understands the market better than others. It wants to justify decisions and protect itself from anything that feels like failure. In everyday life, the ego finds plenty of ways to maintain this illusion. But in trading, the illusion collapses quickly because the market is an environment where being wrong is guaranteed and avoiding losses is impossible. As soon as a trader places a trade, their ego becomes emotionally invested in the outcome. If the trade moves against them, the ego interprets this not simply as market movement, but as personal failure. This is where the battle begins. The need to be right is one of the most destructive forces in a trader's mind. Intellectually, a trader may understand that trading is a game of probabilities and that no single trade defines their success. But emotionally, the mind reacts as though every trade is a test of intelligence, competence, or worthiness. When the market moves against the position, instead of accepting that the trade simply didn't work, the ego goes into defense mode. It creates narratives. It's just a pullback. It'll reverse. I can't stop out now. The market is wrong. I'm right. The trader begins fighting the market rather than following the plan. They widen stops, add to losing positions, or refuse to exit altogether because doing so would feel like admitting defeat. This behavior has nothing to do with strategy, logic, or trading skill. It's pure ego-driven emotional resistance. What makes this even more dangerous is that the ego doesn't care about consistency. It cares about immediate emotional relief. Exiting a losing trade confirms being wrong. Staying in it, even as the loss grows, allows the ego to preserve the illusion of being right just a little longer. Ironically, this attempt to avoid emotional pain often creates much greater financial pain, but in the moment, the ego prioritizes emotional comfort over rational decision-making. This is why traders repeatedly violate rules they know they should follow. It isn't because they lack discipline in theory, it's because the ego hijacks their behavior under pressure. The opposite is also true on winning trades. When the ego becomes attached to being right, it often leads traders to take profits too early. The moment the trade moves in their favor, they fear giving back those gains because losing them would feel like being wrong again. The ego wants to lock in the win to prove it was right. So the trader exits prematurely, not because the market signaled a change, but because the ego couldn't tolerate the idea of the winning trade turning into a loser. Ironically, the need to be right often leads traders to cut winners short while letting losers run, exactly the opposite of what disciplined thinking demands. Attachment to outcomes is another powerful force that overrides discipline. When a trader is attached to a specific outcome, profit on this trade, a green day, hitting a certain target, they lose the ability to think in probabilities. The mind becomes fixated on a desired result and begins to interpret the market through the lens of what it wants to happen, not what is actually happening. This attachment creates emotional tension. Fear arises when the market moves against the desired outcome. Hope arises when the market moves toward it. The trader becomes unable to see the chart clearly because the chart is overshadowed by emotional expectations. When attached to outcomes, traders take trades they shouldn't because they want to win. They avoid trades they should take because they fear the potential loss. They deviate from the plan because the plan becomes secondary to the emotional need for a particular result. This destroys consistency, not because the trader doesn't know what to do, but because they are no longer operating with neutrality. They are operating with emotional bias. Disciplined thinking requires emotional neutrality, which means not caring about the outcome of any individual trade. This sounds simple but is incredibly difficult because it contradicts deeply rooted beliefs about success and failure. The ego makes every trade feel significant. It convinces the trader that they must win now, that they must not lose today, that their identity depends on the result. As long as this emotional weight exists, discipline will always be fragile. Traders may follow their rules when things are calm, but under pressure the ego resurfaces and takes control. Another subtle way the ego interferes is through overconfidence. After a winning streak, the ego becomes inflated, whispering that the trader has figured it out. This illusion of mastery leads to risk-taking behavior that violates the principles that produced the earlier success. The trader increases position size, takes impulsive trades, ignores stop losses, or trades emotionally instead of mechanically. The ego wants to feel powerful, skilled, and exceptional, and after a series of wins, it uses those victories as evidence to justify irrational risk. The illusion of being right becomes more intoxicating than discipline, and eventually the market punishes the trader for abandoning objectivity. On the other side of the spectrum, when the ego is bruised by losses, it often leads to revenge trading. The need to prove oneself reemerges as the trader tries to force the market to give back what was lost. Revenge trading is driven entirely by ego. It is an attempt to regain emotional balance, not financial balance. The trader is no longer following the market. They are reacting emotionally to pain. The more they try to prove they are right, the more chaos they create. Revenge trading is the ego in its purest form, acting impulsively, aggressively, and irrationally to soothe its wounded pride. The real challenge is that most traders are unaware of how much their ego controls their decisions. They think they are being rational when they are reacting emotionally. They think they are protecting their capital when they are protecting their identity. They think they are making strategic choices when they are avoiding discomfort. The ego operates subtly, often disguising emotional impulses as logical reasoning. It takes deep self-awareness to recognize its influence and even more awareness to override it. Disciplined thinking is not about forced control, it is about alignment. When a trader is truly detached from outcomes, when the ego no longer interprets wins and losses as reflections of personal value, discipline becomes natural. Rules become easy to follow because they no longer create emotional conflict. A loss is just a normal event, not a threat. A win is just a positive result, not proof of superiority. The trader becomes free to operate from clarity rather than fear, greed, or pride. To reach that state, a trader must shift from an outcome-based mindset to a process-based mindset. They must let go of the illusion that being right matters. They must accept uncertainty as an inherent part of trading. They must stop personalizing outcomes and start viewing each trade as a simple expression of an edge within a probabilistic framework. This is emotional acceptance, not intellectual understanding. When the ego no longer needs to be right and the mind no longer attaches to outcomes, the internal resistance disappears. Discipline becomes effortless rather than forced. The ego will always exist, but it doesn't have to control behavior. The trader's job is not to eliminate the ego, but to recognize its influence and choose a higher level of awareness. When the ego demands validation, the disciplined trader acknowledges it but does not obey it. When the need to be right surfaces, the disciplined trader chooses to follow the plan instead of the impulse. When attachment to outcomes arises, the disciplined trader returns to probabilities and process. Most traders fail because they never learn to separate their sense of self from the outcome of a trade. They allow the ego to dictate decisions, and the market punishes them for it. Success in trading isn't about intelligence, strategies, or indicators. It is about the ability to operate without ego-driven interference. It is about thinking clearly while the mind tries to protect its identity. It is about following rules while emotions demand something else. It is about accepting that being wrong is not a threat, but a natural part of the game. The ego, the need to be right, and attachment to outcomes override disciplined thinking for most traders. But the trader who masters these internal obstacles becomes something rare, someone capable of acting with consistency, neutrality, and clarity in a world defined by uncertainty. And that mastery is the true foundation of trading success. Traders fail because they never truly accept uncertainty. At first, this sounds like a simple philosophical statement, but in trading, it is the defining psychological barrier that separates those who struggle endlessly from the few who eventually achieve consistency. Most traders believe they accept uncertainty because they intellectually understand that the market is unpredictable. They recognize that no one can control the next tick or candle. They know that outcomes are not guaranteed. But understanding uncertainty is not the same as accepting it. Acceptance requires emotional surrender, a complete letting go of the need for control, prediction, and certainty. Most traders never reach that level of emotional acceptance, and this gap becomes the silent force that destroys discipline, consistency, and decision-making. At the root of the problem is how deeply humans crave certainty. Our entire upbringing shapes us to seek predictability, structure, measurable outcomes, and causal relationships. From childhood, we are rewarded for providing the correct answer, punished for mistakes, and taught that effort leads to expected results. Life is filled with routines, patterns, and expectations. In school, if you study, you pass. If you work hard, you improve. If you follow instructions, you succeed. These conditions create a psychological blueprint that leads people to believe that the world is understandable, definable, and controllable. But the market does not operate within any of these frameworks. Trading reflects randomness, probability, and freedom, conditions that directly conflict with traditional conditioning. Because of this conflict, the mind resists uncertainty automatically. Even when a trader says, anything can happen, their emotional system does not believe it. The ego interprets unpredictability as a threat. The survival mind interprets randomness as danger. The heart interprets losses as failure. The mind wants the market to follow patterns, respect analysis, reward hard work, and provide reassurance. So traders continually try to turn the market into something predictable, even though the core nature of the market is uncertainty. This is why traders spend years searching for certainty through external means. Perfect indicators, foolproof systems, holy grails, insiders, complex algorithms, and endless analysis. They are not searching for knowledge. They are searching for emotional security. They want a feeling of control. They want something that promises that uncertainty can be defeated. Yet every technical tool, every strategy, every market structure principle, every backtest, even when useful, still operates within the same reality: uncertainty is unavoidable. Until a trader internalizes this truth emotionally, not just intellectually, they will continue to fight the market. They will hesitate, overanalyze, and constantly seek additional confirmation because they believe more information will protect them from uncertainty. They will miss opportunities because they cannot accept the risk that comes from not knowing. They will violate rules because uncertainty triggers fear, and fear overrides logic. They will hold losing trades because uncertainty makes them cling to hope. They will exit winners early because uncertainty makes them fear reversal. Every trading mistake has its roots in the inability to embrace uncertainty. Accepting uncertainty means accepting that each trade is unique, independent, and unpredictable. It means that even the best setup can fail, and the worst setup can succeed. It means that a losing trade is not an error, and a winning trade is not proof of correctness. It means understanding that a strategy does not guarantee results. It simply provides a statistical advantage over a large sample size. And it means that the outcome of any single trade carries no meaning beyond being one data point in a much larger probabilistic framework. However, traders resist this reality because uncertainty feels like vulnerability. Humans are conditioned to avoid vulnerability at all costs. The mind wants to protect itself from emotional pain, and uncertainty threatens emotional safety. When a trader enters a position, the possible outcomes create a state of emotional exposure, the possibility of loss, the risk of being wrong, the fear of embarrassment, the fear of missing out on gains, and the fear of losing control. These emotions create internal tension that makes uncertainty intolerable, and the trader responds by trying to control the uncontrollable. One way traders try to control uncertainty is through prediction. They obsess over trying to know what the market will do next. They analyze, forecast, and formulate narratives. But prediction is the ego's attempt to eliminate uncertainty by imposing meaning on random movement. The more a trader tries to predict, the more emotionally attached they become to the prediction. When the market diverges from that idea, the trader experiences internal conflict. They hesitate. They freeze. They adjust analysis to fit expectations. In extreme cases, they average down or refuse to exit, because accepting the loss feels like accepting uncertainty won. Another way traders avoid uncertainty is through over-preparation. They believe that enough research will make uncertainty disappear. They drown themselves in charts, indicators on top of indicators, market news, and opinions. This creates the illusion of understanding and the illusion of control. But when the moment comes to execute, uncertainty remains. The market still moves unpredictably, and the trader realizes that no amount of knowledge can remove the emotional discomfort of risk. Some traders avoid uncertainty by refusing to act unless they feel completely certain. They wait for the perfect setup, the perfect candle pattern, the perfect confluence. They wait so long that the opportunity passes or the trade becomes overcrowded. Their pursuit of the perfect moment is not discipline. It is fear disguised as caution. They are waiting for uncertainty to disappear before acting, but uncertainty never disappears. So they remain trapped in inaction. Other traders attempt to defeat uncertainty through control of results. They stare at every tick, micromanage trades, and suffocate their own edge by interfering prematurely. They constantly move stops, take profits too early, or avoid risk altogether. Their need to control outcomes destroys their ability to let the market play out naturally. They are so uncomfortable with uncertainty that they must satisfy the emotional need for control, even if it sabotages the trade. True acceptance of uncertainty is rare because it requires a psychological transformation. It requires a shift from needing control to embracing randomness. It requires realizing that uncertainty is not a threat, but a neutral quality of the market. It requires letting go of emotional attachment to outcomes and trusting probability instead of prediction. When a trader truly accepts uncertainty, something remarkable happens. Fear diminishes. Attachment dissolves. The ego quiets. Instead of trying to predict the market, the trader begins responding to the market. Instead of seeking certainty, they seek consistency. Instead of fighting randomness, they work with it. Their trading decisions become clearer, simpler, and more aligned with their edge. They no longer panic during volatility because uncertainty is expected, not feared. They no longer hesitate because the outcome of a single trade doesn't matter. They no longer overreact to losses because losses are understood as normal. They no longer get euphoric from wins because wins are simply part of the statistical sequence. Accepting uncertainty means accepting that success comes from sample size, not individual outcomes. It means valuing process over prediction, execution over emotion, probabilities over certainties. When this shift happens, the trader becomes consistent, not because their strategy changes, but because their relationship to uncertainty changes. Most traders fail because they resist this psychological shift. They cling to the illusion that certainty can be found, that losses can be eliminated, that prediction can be perfected. They spend years trying to defeat uncertainty, rather than learning how to coexist with it. And the more they resist uncertainty, the more emotional turbulence they create. Trading becomes stressful, chaotic, frustrating, and unpredictable, not because the market is that way, but because their internal response to uncertainty is unstable. The truth is that uncertainty is not the enemy. The inability to accept it is. When a trader finally accepts uncertainty, not as a concept, but as a lived emotional truth, they begin to experience freedom in trading, freedom from fear, freedom from ego, freedom from the need to be right, freedom from attachment to outcomes, freedom from impulsive reactions, freedom from internal conflict. This is the foundation of consistency, not knowledge, not strategy, not prediction. Acceptance. The trader who accepts uncertainty steps into alignment with how the market truly works. The one who resists it remains forever trapped in the psychological tension that prevents clarity, discipline, and growth. The acceptance of uncertainty is the true turning point in a trader's journey. It is the moment when trading stops being a battle against the market and becomes a mastery of oneself. In the end, trading mastery doesn't come from eliminating uncertainty, but from learning to coexist with it. The moment a trader stops fighting randomness, stops chasing certainty, and stops tying their identity to every outcome, clarity finally emerges. Consistency becomes possible not because the market becomes predictable, but because the trader becomes emotionally stable. Accepting uncertainty is the gateway to freedom, and it's the foundation on which all true trading success is built.